All right, well, it's 1 minute after 2. We'll go ahead and get started with today's program. Good afternoon. This is Chris Demers at University of Florida IFAS School of Forest, Fisheries, and Geomatics Sciences at the University of Florida. Welcome to the program today. Today is June 1st, the start of hurricane season, so I scheduled this webinar to coincide with that, to kick off our series on hurricane preparation and recovery. This is going to be the first in a series of, I think, 4 webinars that we're going to do. And we're going to start off by getting our books in order and learn how to determine our basis and about the casualty loss deduction, the status of that program. The tax code has some provisions in it for landowners to use in order to account for losses. Tamara Cushing is our tax specialist here at the school. She's a nationwide expert on this and many topics associated with timber taxes and the tax code as it relates to forest management and forest landowners. She's going to be covering this topic for us today, and that's her contact information there on the screen. I'm going to go through a couple of slides here, a couple of housekeeping things to take care of before she begins her presentation. I want to encourage everybody to utilize the question and answer feature on the webinar screen. There is a Q&A button there. Use that to type in your questions. You can type them in as we go, and we'll collect those, and then we'll answer those after her presentation. If there's something urgent that comes up, you can use the chat to raise a hand or to make a point that you need clarification on. We'll use the chat for that, for urgent questions, but use the Q&A function for questions to be answered toward the end. This webinar is approved for continuing education credits. We've got one Category 1 Society of American Foresters CFE approved. When you registered for the webinars and you need those credit, or you need that credit, you entered your SAF number or your CF number or your state registration license number. If you didn't do that, that's okay. You can email me that number and we'll make sure that that's accounted for and you get credit for the webinar. Just send that to me at that email, cdemers@ufl.edu, and we'll get you taken care of for the CFE credit. After the webinar has concluded, you'll be prompted to fill out a quick survey so we can gather some feedback and some metrics for our reporting on our end for doing these types of programs. Please fill out that evaluation. It's very quick. I think it's 10 quick questions, very short answer, single click questions. And you'll also be reminded with a link in a follow-up email tomorrow to fill that out if you didn't get to it today. The materials for this webinar are available or will be available shortly. I'm going to make sure those are up before the end of the webinar. At that link, that our Florida Land Steward website, if you Google Florida Land Steward UF, you'll get our website pop up. It'll be one of the first to pop up. And if you kind of follow that chain of links there, and I'm going to show you exactly what you're looking for when you get to the home page. Under the picture, you'll see these 4 headings, and that last one that says find recordings, links, and materials for upcoming and past Florida Land Steward events and webinars. Click on that link, and that'll get you directly to the page where you can get to the handout notes for Tammy's presentation. And if you have any questions about that, or if you want me to put that link directly in the chat, I can certainly do that. Happy to do that. And with that, I'm going to go ahead and share the screen, or stop sharing my screen and have Tammy share her screen for her presentation, and she can begin her presentation. Thank you so much, Tammy, for being here today.
Great. Can you hear me okay, Chris?
Yes.
Perfect. I'm just going to verify as we get this going that you see what I want you to see. Do you see the first slide?
Yes, and now I'm seeing your presentation, so you are good to go.
Perfect. Great. Well, thank you everyone for being here. This presentation covers a lot of ground. It's going to cover some information about losses, but also some of the follow through that I think you need to think about as this happens. After any kind of natural disaster, there are all kinds of questions that come up about income generated from salvage harvest. All of that's kind of packed in here. So we're going to go kind of quick. There's always backup material for any of these pieces. And at the end, I've got some resources for you to consult for broader conversations about lots of parts of this. So I have to give a kind of standard introduction. That tax law is really complex. I don't think that's surprising to anybody. I was sitting in an office last week in Washington, D.C. and saw the printed out copy of the code. It's really, really large, very, very complex with tons of detail in it. And I'm just not going to be able to get into all the details. My intent with these types of presentations is to give you enough information to have the conversation if you go to an accountant's office, or to look up more information if you go to do it yourself. And then, of course, there's always other materials that I can make available to you. This kind of content is not static. It will change. What I'm telling you today is up to the date, the best information I have available. But just know that if the powers that be decide to make any decisions, that any piece of this could change. And then, of course, I have to tell you, this is not tax advice today. This is educational in nature. All right, so just a quick brief of where we're going. We're going to start with talking about what casualty losses are. I have to hit bases because that's part of that conversation. What to do with any gains, what financial assistance and what that means to you, and then talk a little bit about reforestation, kind of the after an event. So let's dive right in with kind of what is a casualty loss. So specifically when we talk about timber, a casualty loss is the damage, destruction, or loss of the timber that results from an identifiable event. And so I really want to hit on this identifiable event idea. What this means is I should be able to look in the newspaper or at the weather records and find that event, right? So if it was a fire, I can go to Labor Day weekend for 2020 when I was living in Oregon, and I can find that there was a fire and where it was. That's going to be documented. So that becomes that identifiable event versus a prolonged period of, say, drought. An ice storm is another great example, coming from another region of the country, right? Where we see that it's coming, the weather meteorologists have documentation that that's going to happen, and then they can tell you that it did. And then, of course, we could do a search in the news and we can find it. Okay? This is not to say that weather is the only way we have a casualty loss. It's just the most probable for us. Other examples that are kind of goofy that I'll tell you, like a shipwreck would be considered a casualty loss. Obviously, a shipwreck is not going to impact our forests. So other than that identifiable event, there's these three concepts that really define what's a casualty loss. And you need to meet all three of these concepts. It needs to be sudden, unexpected, and unusual. So sudden is probably the most clear for us, is that this is a swift killing of the tree, not this kind of gradual, which is, if you think about drought again, and I'm going to keep using that example, drought is this prolonged, right? The tree doesn't die because it had one day without water. It dies slowly over time. It actually kind of fades out. Now, let me contrast that with a tornado that comes and it snaps a pine tree in half. That tree is dead, right? So when we talk about hardwoods, it becomes a little bit more complicated, right? Because hardwoods will sprout. So figuring out, is the tree dead, is part of that calculus, right? So it needs to be swift, not gradual, not progressive. It needs to be unexpected, which means it wasn't something that was intended or that we could anticipate, right? So yes, we anticipate in Florida, in the Gulf Coast, that hurricanes will happen this year. We can anticipate that there is a likelihood that a part of that coast will get hit by a hurricane at some point, but we don't know when, and we can't say specifically that any one particular area will get hit this year by any particular event. So it's kind of hard to anticipate what's going to happen, right? Versus knowing that we have weather patterns that show us that drought happens on a regular basis, or that southern pine beetle has this regular up and down, and that every year we expect certain amounts. The unintended is really just that you didn't set the fire that burned all your timber. Unusual, it's not a typical day-to-day occurrence, and that's not something we usually have a problem proving in forestry. Hurricanes, tornadoes, ice storms, not a day-to-day occurrence. So you see kind of on the bottom here, fire, hurricane, tornadoes, windstorms, earthquakes, which we don't have too much of those having major impacts on us. If we were in an area where volcanic eruptions, you see auto crashes on there. So if an auto crash happened that was doing massive damage, I don't know, maybe the car explodes and does damage. And then these southern pine beetle kills that happen in a very short period of time, and that's going to be really tricky to prove at that point. So let's talk about what is not a casualty loss. We talked about what was, what is not now. And so I kind of divided this into two categories. We have our normal timber loss, and normal timber losses are not deductible. This is expected mortality, right? We all know this, that not every seedling that goes in the ground is going to survive. So that expected mortality is not going to count. Normal levels of southern pine beetle, the fact that we had a low rainfall year, I overplanted and it crowded and some of the trees died from lack of resources, improper planting and management. Those things are not deductible in any way, shape, or form. And while it's not on here, and a lot of us don't think of it as a loss, if I sell my timber for less than I bought it for, so it's just the fact that the prices went down, that is also not a deductible loss. On the flip side, we have these losses that are deductible but don't qualify for casualty treatment. And these are because we might meet an unusual and unexpected event, but we're not hitting the southern part of it, right? So this would be a severe drought, right? It's unusual to have a severe drought, and I certainly can't expect it, but it doesn't happen fast, right? So it missed that sudden mark. And this is also where we see southern pine beetle categorized. So today we're going to focus on the casualty aspect of it as we're going into hurricane and wildfire season. So now we need to think about how you're actually holding the timber, because how you're holding the timber or how you're holding the asset is now going to determine where and how and any kind of limitations on your ability to actually take the deductible loss. So your best ability to recover this loss is if you're holding it for an investment or a business. And thankfully, in this case, for determining the dollar amount or your ability to do it, we don't have to get into whether you're in it for an investment or for a business, okay? But just a quick side note, really the differentiating factor between whether you're in a business or an investment in forestry is kind of frequency of activities, and how really that frequency is the key one, but it's not the only thing, right? And so there's no hard and fast rules on whether you're in a investment or a business, and this is going to come up when I tell you where to file it. You just have to kind of decide that you're an investment, decide you're a business, and then you need to conduct yourself that way and continue to file that way. Those who are holding it for personal use, those are people that have timber. You might be living on the land, you enjoy looking at it. You might cut down some and use it for firewood at your own house. Maybe you build a log cabin. on your property using that timber, that is going to be that personal use category. All right, here's why I care about whether it's personal use. Personal use has a lot of limitation. So this is also going to be not only that timber that you're using for your own purposes, but it's also your home, anything in your household, your personal vehicles. Those are going to be your personal use assets, right? The only way you have a casualty loss deduction for something that's personal use is if you are in a federally declared disaster area. So there is a very localized windstorm that affects a few folks, but nobody applies to get the federal disaster declaration on it. If that happens and you have personal use timber, then you have no casualty loss deduction for it. If, however, you were in an area where you had a windstorm or a hurricane or a tornado, and it gets declared by the president as a federally declared disaster area, now you don't have this limitation on it. You are able to take some kind of loss on it because it's personal use in a federally declared disaster area. If you're growing that timber for investment or business purposes, you don't need this declaration. And that is something that has been unclear to some tax professionals. Again, I'm going to repeat that. If you are owning your timberland for investment or business purposes, you do not need a federal declaration of a disaster in order to take a casualty loss without the deductions, without the limitations that you see on the screen. So those in a personal use in a federally declared disaster area, you are going to start your loss calculation by subtracting $100 off of whatever your loss is, and then you're limited to 10% of your adjusted gross income. Okay, so there's a lot of limitations on this one, and it's really because it wasn't really for that investment or business use. All right, so for everybody else who's in it for business or investment purposes, you do not need that disaster declaration. I'm just going to keep saying that. But your casualty loss is going to be the lesser of the decrease in the fair market value of the block of your timber that was due to the event. So let's start there for a second. That block is whatever your record keeping unit is. So if I have 40 acres and I manage it all as one block and I keep my basis and I keep all my expenses all lumped in together for that one block, then that is my casualty loss unit. And I'm going to look at what was the decrease in the fair market value of the timber in the entire block. So that decreases what would I get for it today versus what I got for it right before the event. Okay, so that's the top metric. The bottom metric is your adjusted timber basis of the block. So let's say I planted that timber back in 1990, so 33 years ago, and I planted it at a cost of, let's say, $100 an acre. I'm going to be limited to the $100 an acre or the decrease in the fair market value, whichever is lower. Now, if you put those trees in the ground yourself a long time ago, or you bought the trees and they were immature, likely that your adjusted timber basis is lower than that decrease in fair market value. Just kind of keep that in mind, that we're looking for the lower of those two numbers, regardless of what it feels like. All right, so once we figure out which of these two numbers is the lower number, the adjusted basis or the decline in fair market value, then we're going to take that loss in the year that it happens, right? So I'm going to file that on that current year's tax return. If I don't have anything to offset, I have no income from that year, that I can go backwards a year to be able to go offset that. And sometimes people will do that because they can't wait. And there are sometimes some wiggle room to be able to go backwards rather than have to wait another year in order to claim that. If there are multiple owners, and that is often the case, if there are multiple owners involved, we need to allocate that loss by the percentage of ownership. So if you are equal partner with your sibling, then you're equally taking that loss deduction, okay? If you have some other partnership structure and it details who has each percentage of the gains and the losses, the deduction is going to be distributed the exact same way. You will need to provide a lot of information when you go to take this deduction. Let's start with providing proof of ownership, right? Obviously, the Internal Revenue Service is interested in making sure that you are the rightful owner and have the right to take the loss deduction. And that's going to be really important. You have to also be able to document the actual loss. And so this is the part where it's super helpful if you have an inventory that was conducted. The sooner, the most recent, the better. But even if it was 2 years ago that you have an inventory for that property, that is still better than having nothing. You want to be able to show what you had before and what you have now. So before you have somebody come in and do any salvage work or you start cleaning up, take pictures, lots of pictures. A lot of folks have drones now. Take drone footage of the entire property. In fact, I would challenge you, if you're sitting here today and haven't had a loss, go do that. Go ahead and get that drone footage now. I'm not suggesting paying somebody, but if you have one, have a grandchild or child with one, go ahead and get that drone footage now. That's a good record. I would go ahead, if you don't, take some photos of some key identifiable areas on the property to show what it looks like now. That way, if you have a loss, you have the before and the after. That's really what you need to be able to show, that you had a loss. And then, of course, we need documentation of basis. And I'm going to get into basis. I keep using that word, and that's a conversation we're going to get into here in a couple more slides. I will tell you that this casualty loss deduction can trigger what's called a net operating loss, or an NOL. These get kind of complicated. If you find yourself in a loss situation, an overall loss situation for your property, reach out and consult a tax preparer. Have somebody get you some help on this. This is not just standard something that you would know how to do. If you salvage timber, if you're able to salvage or you're able to cash in on some insurance proceeds, you're going to have to take that account into account, the salvage and the insurance proceeds, as you're calculating this loss deduction. So you want to take that off first before you figure out what your loss amount actually is. Okay. All right. So that's all the calculation and kind of some of the mechanics of it. But where are you going to report this? And I kind of at the beginning indicated that you needed to know if you were a business or an investor or personal. And it's because of how you're going to actually report this casualty loss. So everyone is going to start by putting their loss on Form 4684. From there, if you consider yourself to be in the business, and that means you have some kind of frequency of activity out there, right? You're either harvesting on a frequent basis. It doesn't have to be every year, but probably somewhere on your property doing it every 3 to 5 years, you know, having some expenditure, some level of activity, then you're going to go ahead and file it on Form 4797. For the rest of you that are doing this for profit of some form, that's going to go as an investor on Form 1040. There's a Schedule A that you're going to put this on, and it's going to go under your other itemized deductions. Now, I know some of you are thinking, but wait a minute, I claim a standard deduction. I no longer claim itemized. You're going to want to go ahead and calculate it both ways. Calculate it with the itemized deductions and see if that's larger, especially if you've had a large loss that year. You want to calculate it both directions. Those of you that are using the timber on your property for either personal firewood or to do some building on your property, you're going to use Form 40 as Schedule A, and it's going to go on a different line on that form. It will not go in the other itemized deductions. All right, so let's talk about insurance. And this isn't about how to get insurance. A lot of folks don't have it. It's often too expensive for most people. But if you have insurance on your timber and you expect to be reimbursed for some part or all of your loss, what you want to do when you're going to claim that casualty loss deduction is you want to subtract the expected amount of your reimbursement at that point in time. Now, of course, this is just what you expect. You may not be right, okay, but you need to go ahead and do it. You're going to reduce your loss, even if that payment doesn't come until a later tax year. And then when that payment comes, you will then go ahead and make a correction on a following year tax return if you got more or less than you were expecting. If you receive the reimbursement or some type of reimbursement or insurance in the same tax year, so before you get to the point of filing your tax return, go ahead and subtract that reimbursement when you calculate the loss. It's so much easier if you get that reimbursement or that insurance before you file, but it may not happen that way. The Internal Revenue Code it makes some mention about salvage, but there is not a clear line that you are required to actually do a salvage. It is expected that you've made some attempt, but by no means do you have to take a really, really bad offer on the timber just to be able to say you did a salvage. In a lot of cases, it's worth your while to pursue a salvage, but depending on what the casualty event was, it just may not be possible. Thinking back on those Labor Day fires in Oregon in 2020, most folks didn't have anything that could be salvaged, and those that did found themselves having a hard time getting a logger because all of the few loggers that were operating at the time that actually still had equipment that hadn't burned up, they were booked. They already either had previous contracts that they had to honor. Some of them were salvaging on their own properties, and there just wasn't enough work to go around. You could see the same thing happen with a hurricane, that there's so much wood that's down that people are trying to get salvaged that it's really hard to get someone to do it. Obviously, waiting a little bit can be beneficial. Immediately after one of these major events, the market kind of gets flooded and there are lower prices. But there you have to balance that with the fact that if you wait too long, you start losing quality and you're not going to get the same price for it. If you get salvage income, you're gonna call this transaction an involuntary conversion. That's a very specific part of the tax code. And so what happens here is we're going to look at whether that salvage income that you get is bigger or greater than that adjusted timber basis. And if it is, you wind up with a gain. That's why I want you to call it an involuntary conversion if this happens. So at this point, with an involuntary conversion and a gain, you can choose to pay the tax on that gain, or you can defer the gain by purchasing qualified replacement property. And so that's a really nice thing. This involuntary conversion allows you to not pay tax or claim the income on that salvage at that time, right? A lot of folks, they already feel very wounded by the fact that they've lost their timber or had a downgrade in what it was worth. Potentially that was your retirement income. And then it does feel like a second hit when you have to then pay gain on that, what you did salvage. So qualifying replacement property can look like a couple of different things. One is reforestation expenses. So if I did a salvage and I wind up with a gain, I can defer the gain, roll that gain into reforestation expenses. So I go ahead and I get the property ready and I put more trees in the ground, right? So what that does is that gain is going to impact that new stand. So it's going to roll in, it's going to affect the basis of that new stand. That's a little bit beyond this conversation here today, but just know what you're doing is deferring it and kind of rolling it into that next rotation. You could also choose instead to go buy replacement timberland. Now that does not mean you have to have sold the land. You just have lost the trees on the property, but you can take the gain from that involuntary conversion and go buy more acreage that has timber on it maybe already, right? you can buy replacement property and spend reforestation dollars on it. All of these are different ways to stay in the forestry game. And that's what this is going to require. Replacement property that qualifies has to kind of look like what you've lost. The interesting one is this bottom one. You can buy controlling stock in one of the timber corporations that are out there, and that would qualify as replacement property. Now, controlling stock, that means you have to have enough in a dollar value to matter, right? It can't be just a couple shares. All of this purchase of a replacement property that qualifies has to be done within 2 years in order to continue to defer that gain. So in other words, if you salvage your timber, come up with a gain, do an involuntary conversion on it, say you're going to buy a replacement property and year 3 rolls around and you haven't bought it, then you have violated the rules on that and you're going to have to deal with that. All right. So we've talked about the loss itself. There are other expenses that are incurred at the time of dealing with these losses, right? And so some of these are just looking at the costs that we have, the expenses associated with determining what the loss actually was. So any of the costs of determining the casualty, maybe you had to have somebody come out and appraise it to see what the actual loss is. Maybe you needed a cruise. You decided to hire somebody to take photos or run some drone footage to show just the massive extent of the damage on your property. All of that is going to be what we call operating expenses. And operating expenses under most circumstances are items that we would currently deduct, meaning when I file my 2024 tax return, I would take those expenses, just deduct them off that year. However, back to how are you holding the timber as a business or an investment? If you are an investor, you're going to have to capitalize those expenses. And the reason is investors deduct their operating expenses as miscellaneous itemized deductions. And that is currently suspended right now. So landowners who are investors cannot deduct their operating expenses currently. They would have to capitalize them as kind of a carrying charge. So let me recap all that for you. If you're an investor, you can take the casualty loss deduction. I told you where to take it, but the expenses you're going to have to capitalize. Okay? Landowners that are holding timber for use in your trade or business, you're going to file on Form 1040 using your Schedule C or Schedule F and put those operating expenses on there. All right, other ways that we see some things happen related to the same timing. I know with Hurricane Michael, there were some block grants that were issued here in the state of Florida. They were also issued for Alabama and Georgia, and I think Louisiana might, and Mississippi might ultimately have gotten some related to those storms as well. But each state kind of distributed the money with different rules and different reasoning behind what's actually happening. So we'll take Georgia, for instance. Georgia, my understanding was the grants were issued for cleanup purposes, so for getting everything taken off of site. So in the case of a cleanup block grant, you're going to treat that as ordinary income, and then you handle the expenses as I mentioned previously. In Florida, the money that was passed to landowners in that block grant was given as loss compensation, right? So they said, this is because you lost your timber. We need to see some rough estimation of what was out there, how much was out there to determine how much you lost. And so that loss compensation is also considered income to the taxpayer. Okay, so both cases, the money is income, right? The difference is for loss compensation, we're going to look at the timber itself and say, you know what? How would you have been taxed if you cut that timber? If you cut that timber and it would have been ordinary income, then this loss compensation, we're going to call it ordinary income. If you got that block grant for loss compensation and your timber would have sold as capital gains income, then you're going to put that down as capital gains income because it's replacement income for it. So you could wind up with a gain or a loss after getting this compensation, depending on what your basis is. Again, we need to talk about basis. And then, of course, now we can talk about that involuntary conversion stuff again, and whether you need to do replacement property and defer the gain. So you see all these topics are starting to kind of roll into each other. All right, I keep beating around this. We're going to have a quick version of what is basis, because you need to know this number in case you have a loss. So basis is just the measure of your investment in a capital asset. And for our purposes today, that timber is going to be your capital asset. And some of you may say, well, I didn't spend any money for it. Just hang with me for a minute. But I need you to think about that investment as more than just outlay of money. It could be a decision not to harvest it when you acquired it. So this basis is important when you have a sale, or if you have a casualty loss situation. We need to know what that basis is. You heard me say that multiple times. And the reason is it's going to reduce your taxable gain, or it's going to determine what you can actually deduct for casualty loss purposes. So the actual dollar amount that of your basis depends on how you got the property, right? So you could buy the property, you could inherit it, you could get it through a gift, or you can get it through an exchange. And each one of those ways of acquiring property has its own rules that have nothing to do with timber, but those rules are just our general income tax code rules for how we determine basis. It could be talking about a work building that I own. How did I get that work building? And that's going to determine what the basis is for that building. So we're going to talk first about the purchase property, mainly because most folks know what they purchase. So it's the total amount you paid for it. And when I say the total amount, you know, I'm going to give you X amount of dollars for this piece of property and everything that's on it, right? But I also have to pay fees, right? I have an attorney who's going to handle all the titling stuff. I have to pay maybe a commission to a realtor if I use someone to help me. And then if there were any sales taxes, title fees on the transaction, all that's going to be pulled in there. Key here to know, we are not going to index that number. So for inflation. So if I bought this property in 2020, then it was what I paid for it in 2020. Okay. So regardless of how long I hold it, it's what did I pay for it? What was the amount of the basis when I got it? That's always a driving factor. You can see that would make a big difference if everything grows in value over time. If I got the property through an inheritance, the basis in my property is equal to the fair market value at the date of death. So I inherited from my grandmother who died in 2012. Then it's what was the property worth the day she died in 2012. Again, that number will not change from 2012 to 2023. There's no indexing. It's what was it at that time. There's also this alternate valuation date. If that was elected by the executor, then that's the date that everything is valued on, and that's what's going to matter. The reason inheritance is important is it gets you a step up in basis. That's terminology that you might hear occasionally. All it means is my grandmother, she bought that property in 1980 and she got a deal on it and she paid $500 an acre for it. When she died in 2012, it was worth $3,000 an acre. So it went through the estate process, it went through probate, or it went through the titling process. I get it at that $2012 amount instead of getting her basis from 1980. It just kind of stepped up the value on everything. And then, just a quick note, if you receive it through an inheritance and you find out that special use valuation was elected to value it for ag or farm or ranch purposes or forest purposes, then that's going to have a different valuation than fair market value. And you're going to want to know that because that's the number that's going to be your basis. All right, so regardless of which way you got the property, you're gonna take that dollar amount from the time you got it in that basis determination, and we're gonna split that out among everything on the property. Now, you can probably understand why this is really important as we're talking about timber and casualty loss, right? If I have a hurricane, for the most part, the hurricane didn't hurt the land itself, right? Probably did not change the value of the land. It might have taken everything off the land. It might have destroyed the timber, but it didn't affect the land. So what I'm required to do is take that purchase price or that inherited value and assign that basis to each of the pieces that I acquired. So if I got it from grandma, there was value in the land. If there was standing timber, merchantable timber that could have been cut at the time, I need to put a dollar value on that, put a dollar value on the little trees that she planted the year before she died, and then any of the buildings on the property. Now, in an estate, maybe there was an appraisal and you may actually know these actual pieces. If you bought it, you likely do not know the dollar amounts for each of the pieces. Regardless, we need to work through that. It's not a super hard process. I'm going to go through it kind of quick. You can always come back and watch this recording, slow it down, and if you still need more guidance, I've got it in other places for you. I'm going to walk through it as if you purchased it. So we're going to take it and we're going to take that purchase price and split it among all those pieces. For land, we're really kind of probably looking at what comparable sales of land. So what is bare land going for in the area that's similar in size? If I'm looking at timber, if I'm looking at merchantable timber, I can take the market price when I got it and the volumes when I got it to figure out what would, if I sold the timber today, it be worth. If it's pre-merchantable timber, it's more complicated. You're probably going to need the assistance of a forester to help you get to what that pre-merchantable timber is worth. So just a quick example, not to belabor it, but if I bought it for a purchase price of $100,000 and we decide the land was worth $65,000, the timber is worth $10,000, the pre-merchantable timber was $10,000, the merchantable timber is worth $50,000. All those pieces add up to $125,000. And I'm not saying this is perfect. Obviously, if it was perfect, it would exchange for the exact fair market value of the pieces. That never really happens. This is a mechanism, a tool to kind of figure out what the pieces might be worth. So what we're going to do, knowing that it's not perfect, is we're going to allocate it on a percentage basis. What is the percentage each of those pieces, allocates to the whole? So if I look at that merchantable timber, I said it was worth $50,000 of a total $125,000 fair market value. So basically, I'm saying 40% of the total fair market value is attributable to that merchantable timber. Okay, so we do this for each of the assets, make sure it all adds up. What comes next, I'm going to kind of forget about that fair market value column. It really needs to be in your file. It's just kind of proof of methodology in case you get audited. Where you got the numbers from is what the auditors actually care about, right? And then this process is accepted by the IRS. I'm going to take that 40% from that middle column from the merchantable timber, and I'm going to multiply that by my total purchase price of $100,000, right? So that tells me that of that entire $100,000 I paid for it, $40,000 of it I can attribute to the merchantable timber account. Now, some of you are going, okay, but if I cut it right away, I'm going to have a gain of $10,000, and that's true. What this is doing is it's saying that you paid less in theory by a piecemeal way than what the total fair market value is. And we're going to spread that savings out among all of the pieces so that each piece takes a little bit of the fact that you got a deal on it, even though it may not have been a deal. Okay? Hopefully that's clear. If we need more understanding of it, ask in the chat, in the Q&A. So what happens now, usually with a casualty event, we find people have not done that process that I just showed you. And so what that means is we kind of need to do a retroactive basis determination. It's not uncommon. It does become harder, especially when the timber is gone. So if there's no standing timber, it becomes a little bit harder if you've done something in the meantime. Bottom line, what you're doing is you're trying to back up into, I got it from grandma in 2012. What were the pieces worth in 2012 when I got it, right? If I bought it in 2012, I can find what I paid for it. Maybe I even have loan documents on it, but now I need to back up into the pieces. I'm going to do the same thing I just did. I just need to remember I need timber prices from 2012. I need the volumes from 2012. That means I'm probably going to have to estimate. I'm going to have to backwards the volume. I'm going to have to grow it in reverse, right? And in that case, I'm going to need a forester to help me. I can do this with growth rates. Maybe there was an inventory floating around from real close to that time that I can use. If I put a new stand in the ground, so grandma left it to me in 2012, I harvested, and then I put new trees in the ground. The basis in those new trees is whatever it cost me to establish it. So kind of pulling us back to the casualty loss, if those trees that I planted in 2013 are what I lose in 2023, the basis limitation, the adjusted basis, unlimited to what did it cost me to put those trees in the ground. That was my basis in 2013. Okay. All right. So the words I used in the beginning, we're talking about being limited to the adjusted basis. All that is recognizing the fact that that original basis, what we calculate when we get it, gets adjusted over time. And that gets adjusted because I have a sale, or I have a loss, or I add some money into the system, right? I do something that increases value. All right, so how do we recover expenses if I have to do a sale? I deplete the timber, I start recovering it in proportion to the volume sold. I'm not gonna go over this right now for time, but I just want, this will be in front of you. If you do a timber sale after you have a hurricane come through or a tornado, you actually do a timber sale, this is the information you want to look at. It talks about how we recover that basis if there's not really a loss, but you're just doing a timber sale. Again, some more information. I feel like I have to tell people some of this. If you sell the timber, there's different types of income. Want to make sure that if you hold it for more than a year, that you're claiming this timber sale income as capital gains income. So back to that block grant, if you get compensation for the loss and you held it for less than a year, then it would be ordinary income. If I'd held that timber for 5 years when it was lost in that casualty loss and I get the block grant, then it's going to be capital gains income. You want to do this because it has lower tax rates. You don't pay self-employment tax, and it allows you to offset gains and losses. Again, how long you hold it is one of the major factors for whether it's going to be capital gains or ordinary income. I'm going to skip the examples, but you can go back and see these. Chris is putting up this PowerPoint so you have access to it. Put a lot of information in there in case we had time to get to it. I apologize. This is, again, just kind of working through an example of how this would look. This is, again, on recovering your basis. I'm going to leave that for you for later. My apologies. This is if you did a partial timber harvest. This is likely what you would see happening if you had a sale after a hurricane comes through and it doesn't take out all your timber, it only takes some of it. This process is going to tell you how to recover your basis in the timber when you do a sale for only part of it. Again, this is just part of the example. I'm going to keep going. And this slide's really just letting you know that there are some additional taxes if your capital gains income bumps up over $200,000 in that particular tax year. So unfortunately, this feels like adding insult to injury. If you have a hurricane come through, it takes your timber out, you do a salvage sale, that salvage sale brings in enough income to trigger an additional tax. So just keep this in mind. I'm gonna skip cost share because it'll be there for you. I put too much in here trying to make sure you knew it. One thing I want you to be very knowledgeable about is if you have this casualty loss situation, you've lost your timber from a casualty, there are provisions in the income tax code that can help you with reforestation related expenses. So go ahead and do the casualty loss deduction if you qualify for it. But realize that the tax incentives don't stop there. That if I go ahead and I put trees in the ground, or I do site preparation, maybe I have to remove the stumps, or I have to clean up the property, that the tax code allows you to do the outright deduction of up to $10,000 of reforestation related expenses per qualified timber property per tax year. So you have either a sale of timber, or you have a casualty event, you do some site prep, or you do replanting, you can deduct up to $10,000 that tax year for site preparation and planting expenses. And then whatever goes over that $10,000 in that tax year, you can then write it off over the next 7 tax years. That's what amortization means. So you're going to take whatever goes over 10,000 and you're just going to deduct pieces of that over the next 7 tax years. That will allow you complete recovery of all that reforestation related expenses. Again, I put an example in here to kind of show you. Chris is going to post this so you'll be able to look at that example. The nice thing about this particular provision is it's usually available every year. It only goes away if up in Washington, D.C., they decide to take that incentive away. So it's there every year. You can do site preparation in one tax year and then do planting in the next tax year. That would allow you to take the up to $10,000 expense each year, each of those 2 tax years. It has to be done on your timely filed return. You cannot do this on an amended tax return. If you're a tax preparer and you're listening to this, please make sure you hear that this is not something that can be amended. The landowner will have to take this on that tax return. So if I plant in 2023, I need to take that off on next April's tax return. If I make a mistake and don't do it and I catch it within 6 months, I can fix that. There's a particular code section or regulation that you can cite. But after that, it's gone. It will then have to be capitalized and it will sit in a basis account until the time that you start selling timber. If you have, less than $10,000 worth of expenses, you're limited to that, whatever you used. So it's $8,000. You don't get to carry the $2,000 over to the next year and add it to that 10. Know that there are some recapture provisions. Recapture just means that if you sell that timber within 10 years of taking this incentive, that you will have to pay interest and penalties on the benefits. So make sure that you're going to hold on to the timber and the land for at least 10 years if you take this incentive. The next few slides are just telling you how to do it. So I'm going to go past that. This is one of the final things I want to tell you. In case you're hearing about proposed legislation, changes to this casualty loss limitations, this is something that has been proposed by some of our senators and congressmen. It's called the Disaster Reforestation Act. It has been proposed. It is sitting in the Senate Finance Committee right now, but it has not gotten any further. It does have support from numerous folks on both sides of the aisle, and we do have several landowner organizations that are working really hard behind the scenes to get lots of support for this, at which point it gets pushed to the floor for any kind of conversations. It will result in improved tax deductions for you. You will no longer have that limitation of your adjusted basis. But right now, that is where we're at. It is limited to your adjusted basis or the decline, whichever is lower. So stay tuned on this. I just want you to know about it. Some quick end notes. Make sure you keep excellent records to substantiate what you're doing and why you're doing it. Any of these decisions that you're going to make on what you're doing related to this issue should be thought about with regards to what your final objectives are on the property and your timber, thinking about the biological, financial, and legal factors. It's never just one piece of the puzzle. It's never just one thing that makes your decision. This is complicated. I did my best to make this as simple as possible. The stuff I went past is not really even the complicated stuff. That's why I went ahead and passed it. But make sure you have good advisors. Not all foresters are versed in this, and that's not any fault of their own. There's a lot that they're trying to keep track of. Not all your tax preparers are versed in this either. And the best thing I can tell you is to plan. Some resources for you. I think Chris is going to be able to probably link to these resources on the website. Ag Handbook 731, it's out of date. There are some things that have changed specifically on casualty losses. So any deviation between what I've told you today and what you read in there, I'm going to tell you to defer to this webinar for the most up-to-date. Same thing with the Hardwood Timber Industry Audit Technique Guide. It's a guide for the auditors, for the IRS, if they come to audit you. It's also from 2012, so there is some deviations, but there's still great information in there. And then the link down below, these webinars we did January, February of 2022, there's a whole webinar specifically just on the losses, but there's also another one specifically on basis and one on timber sales. So that was the whirlwind tour through casualty losses and all the things that are kind of associated with it that I wanted to bring to you today. So Chris, I don't want to take it off the screen, but I wanted to see if you had anything.
Okay, very good. Thank you very much, Tammy. That was excellent. I don't believe we have any questions that have come in on the Q&A.
Either I did an amazing job or they're just scratching their head because there was so much, right?
Those are the options, I guess. I did put in the chat the link to Tammy's presentation slides, and those are up and live now. I just checked them, so they're available at that link. Just go up to at the very top of the page, you'll see 2023 webinar and event materials, and that's the first event on that screen is our Tammy's slides are right under there. So if you have any trouble, just drop us a line, drop me an email, or drop Tammy a line. We're happy to get you connected with that information.
And you've got Chris put my email up. I'm happy to answer questions. If you find this all a little overwhelming and need to have your tax preparer talk to me, that's fine too. I handle questions from them as well. Email is usually best, but I'm happy to help however I can. And hopefully nobody needs this information this year.
Fingers crossed. Fingers crossed. But don't be complacent. Make sure it's always a good idea to have everything in place and ready to go just in case something does happen. And we'll be talking more about that on the next webinar in this series. The next one will be on June 15th. We'll be talking about some important connections to make and things you can do to get ready for the storm. And it looks like we've got
there's a question there. The question was, how many years prior do you think a cruise can be used? You're not going to like this answer, and Chris probably knows where I'm going with this. It just kind of depends on a lot of factors. One of those is like the level of the cruise. Cruises are done at different levels. If this was just a low level statistical cruise, probably not as good, but a really good maybe inventory that was done when somebody acquired it or for a management planning purposes. I would say, certainly within 3 years in the South, I would feel okay. Getting closer to 5, I'm starting to get a little bit squirrelier about it. And I would probably want to make some adjustments to it. but those adjustments need to be grounded in something, right? So if you came to me as a forester and said, it's gone, and I've got this cruise from 5 years before, then we could certainly make some adjustments for growth that we would think might have happened. What we want to do at that point, though, is make sure we have a forester who can back up what they're saying. And the reason you want to back it up is in case we get to the point of an audit, right? And worst case, I had somebody ask me a couple weeks ago, they said, well, you know, it kind of depends, and I don't agree. And I had 2 people in the room that didn't agree. If it came to the point of a tax court case, the IRS brings up their expert and the landowner brings up their expert, can we say that they're both reasonably agreeing on certain points, right? That Chris and I, as 2 foresters, maybe Chris uses 1 growth percent and I use another, but they're actually pretty close together. That's fine. What you don't want is Chris using 1 percentage and me using another, and they're separated by 3 or 4%. That's too much, right? So we're looking for something reasonable to adjust it, and that we document how we did it.
Okay. Anything else? You're welcome, Lee.
Everything is document, right? Document, document, document. How did you do it? Where did you get the information from? You know, if it's timber prices, they came from Timber Mart South, from the quarter I got it. And I took the average price because I'm usually in the average price region, right? Everything is documented.
All right. Any other questions? We'll stay online for another couple minutes to capture any questions. While we're here, I will make another mention that a survey will be popping up in your browser, or it should, following the webinar, and you'll be getting an email tomorrow with the link to that survey. So please take a couple minutes and fill that out for us, and we can use those results in our reporting for the year. We appreciate your feedback. Again, the materials are on that webpage, and I'll go ahead and go through that again on how to find that. If you go to our homepage, go to this homepage, and right there on that last item, links to materials. That's where you're going to find that page, and 2023 is right at the top, and Tammy's webinar is right at the top there, so you won't have to look too hard for it. And we've got recordings and links to materials from a lot of other past events and webinars there as well. So it's a good place to browse, and you might find something that's probably going to be useful to you. So go ahead and stick around on that page and browse around for resources. I want to thank all of our partners and supporters that support our program each year: the Florida Forest Service, the Florida Fish and Wildlife Conservation Commission, the USDA, of course, the parent agency to the U.S. Forest Service, where a lot of funding comes through to support our program. Florida Forestry Association is a great industry partner. The Florida Tree Farm Program, many of you, if you're landowners, you're probably certified or getting certified in the tree farm program. That's a great connection, and great connection to many resources, including ours at UF. And then, of course, the Sustainable Forestry Initiative Implementation Committee, which provides us a pretty good portion of our operating expenses each year. So thanks to all those sponsors and supporters. And I will also say, if you are tuning into this webinar and this is your first connection to our program, I'm going to go through and make sure that everybody is connected to our regular email updates, so you can keep posted and have direct links to our upcoming webinars that are coming up. I know there's a couple of you that tuned in from Alabama, so I'll put you on our Florida Land Steward email list, so you can have easier links to connect to these webinars in the future, especially these ones that are coming up in June about the hurricane preparation and recovery. Let's see, I don't see any more questions coming in, so I believe that we will go ahead and sign off. Tammy, thanks again so much for your presentation. That was excellent, very helpful, very thorough stuff in there that I hadn't considered before or knew about. So that was good information. All right, everybody. Well, thanks for tuning in. And again, get a hold of those materials and drop us a line if you have any further questions. Have a great day.